welcome to Macros with Mythili, the 18-hour show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week, we're going to take a hard look at two major developments that have cast their shadow over the global economy and financial markets in particular. The meeting of the US Federal Open Markets Committee last week and the forthcoming referendum in UK on the issue of whether Britain should remain in the European Union. Fortunately, the Fed opted to stay pat, in line with expectations. So that's one uncertainty out of the way. But we have another, Brexit, looming ahead. What does all this mean for the world economy, and India in particular? Join me to make sense of it all is Ishwar Prasad, Senior Fellow at Brookings Institution, Washington, and Senior Professor of Trade Policy at Cornell University. Welcome to the show, Ishwar. Ishwar, the US Federal Reserve kept interest rates unchanged on Wednesday, but it signaled that it still planned to raise rates twice in 2016. Given that in December 2015, when the Fed first hiked rates after close to a decade, it had said that it was on course for 4 rate hikes in 2016. How seriously should we take their latest signal of just 2 rate hikes?
Now, certainly the Federal Reserve has indicated that it is going to be guided by the data, and the data have been fairly mixed. Certainly the US economy seems to be doing all right. Although even there the indications are a little mixed. The employment growth numbers for the last month were not very promising, fewer than 40,000 net non-farm payroll jobs being created, but the unemployment rate is holding steady at about 4.7%. There are no strong signs of inflationary pressures, but wage inflation is still in the range of about 2.5%. So under normal circumstances, the Fed might be thinking about trying to get ahead of inflationary pressures coming. But what the Fed is having to contend with right now, which is creating even more complications in its decision making, is a very uncertain external environment. In particular, there are concerns about what might happen next week when Britain votes on whether to stay in the European Union or not. The referendum will take place on the 23rd of June, and right now it looks like it could go either way. And certainly if it is a vote to exit from the EU, it could cause a lot of turmoil in financial markets, which could lead to more money coming to the US in search of a safe haven and drive up the dollar. And then there is a question about whether China is in fact slowing down and could add to turmoil in the global financial system. So the external factors are making it even more difficult for the Fed to read through the tea leaves. And certainly financial markets don't seem to be taking the Fed at its word that there will be a couple of rate hikes. In fact, most of the path of future rate increases being priced in by the market certainly suggest that the Fed may act later and may act in a much more moderate fashion than the Fed itself has been suggesting.
Agreed, the Fed has given a number of reasons for staying put, but the fact is you never get macroeconomic data pointing unambiguously in one direction. If you did, you wouldn't need a Janet Yellen to interpret it for you and make that informed guess, as some have put it. So it's really up to the Fed chairman to make that judgment call and then explain why. But what we are seeing instead is some amount of what can only be called flip-flop. So at the September meeting last year, the slowdown in China was advanced as a reason for status quo. In December, the Fed went ahead and raised rates, even though the position in China had not really changed significantly. So does the Fed come across as whimsical rather than informed? And does that inspire confidence?
Now, the Fed is in a very difficult position because even the domestic factors are not providing a very clear picture about the amount of momentum in the economy. The labor market does seem to have healed to a significant extent if one looks at the employment growth numbers, if one looks at the unemployment rate, but at the same time the participation rate, that is the number of people actively engaged in employment or in looking for a job, that is still down by about 3 percentage points relative to the level in 2007. The amount of part-time employment is still very high, so it doesn't seem like the normal relationships between labor market indicators such as the unemployment rate or the employment growth and their connection to wage pressures and inflationary pressures can be counted on anymore. So the Fed is operating in very, very uncharted territory because all the traditional relationships in terms of what the Fed looks at and their effects on wage pressures and inflation don't seem to be holding up very well. Towards the end of last year, there were some concerns about imbalances building up in the asset market, because ultimately the decision the Fed makes is really weighing costs and benefits. And it seemed like the imbalances building up in certain parts of the asset market, certain parts of the securities markets, and also in certain sectors in the equity market, those caused some concerns. Many of those concerns seem to have dissipated right now. So ultimately, it's going to be certainly a judgment call, and the Fed has to respond to data as they come in and its reading of the economy. And certainly, the picture isn't any clearer now than it was a few months ago. So I think the Fed is in a difficult spot. One other interesting point I'd like to make is that the way monetary policy is supposed to work is that if the Fed were to increase short-term interest rates, that would also increase long-term interest rates, which would increase borrowing costs and therefore dampen domestic demand slightly and reduce inflationary pressures. That channel too is not working the way one might expect. The Fed did raise short-term interest rates towards the end of last year, but long-term interest rates, say the 10-year bond yield, is lower today than it was back in December. So even the traditional channel for the transmission of monetary policy from short-term policy rates to long-term rates and then to economic activity doesn't seem to be working in the traditional way. So the Fed is really operating in very complicated and uncharted waters.
But it's only in an ideal world that you really get data that's completely unambiguous. So isn't it a trifle naive to expect unambiguous data in the real world?
That's going to be very difficult to judge in advance, and that's the point the Fed has been making, that they are going to be driven by the data. And the Fed is in a difficult spot because, I mean, ultimately, the monetary policy actions of the Fed do have significant implications for the Fed and indeed for the entire world economy. So the Fed has to be careful now. Last year, I think the Fed boxed itself in a little bit by making a calendar-based statement saying that they would move towards the end of last year. So the Fed has been somewhat more cautious this time in saying that based on the current track of the economy, that they anticipate 2 more Fed hikes, but they've equally hedged themselves by saying that it's going to depend on what data come in. So in addition to the economic challenge, there is a very difficult communication challenge that you are correctly putting your finger on, Mythili. What should the Fed be trying to signal to markets at a time when there is great uncertainty and the Fed is trying to appease some of this uncertainty? But the unfortunate reality is that although the Fed may have a little more information, a little more data, what the Fed sees is pretty much what the rest of us see. So it's not obvious they have a huge informational advantage. And I think it's going to be very hard to expect much more clarity from the Fed in terms of when they might move or how much they might move. We'd all like more certainty from the Fed, but as the Chinese central bank governor said in a recent interview, people expect central banks to be either a god or a magician, and central banks cannot be either.
You spoke of the importance of good communication, but Alan Greenspan, the former Fed president, was famous for what he called mumbling with great incoherence. And though Janet Yellen does not mumble, she is just as incoherent, if you ask me. True, any action will necessarily be data dependent. But what is one to make of statements like, I'm not comfortable to say it's in the next meeting or two, but it could be. It's not impossible that by July, for example, we would see data that led us to believe that we're in a perfectly fine course. What kind of vague statements are these, and what does it say about central bank communication?
Financial markets and markets in general would like certainty more than anything else. But I think everybody has to understand that the Fed and other central banks are in a position where they cannot give markets the certainty they need, because they themselves are facing a very, that is, the central banks themselves are facing a very uncertain environment. Now, in terms of central bank communication, I think there's been a lot of progress in recent years towards greater and greater transparency. And this is a good thing in terms of thinking about what the strategy of the central bank is, what its objectives are. But the reality is that central banking ultimately is, as many have said before, an art rather than a science. And the central bank cannot afford to prejudge what it might do without seeing the data. And the data, frankly, have been very, very murky. So I think Janet Yellen and most other central bank governors in her position around the world are taking the position that they cannot give the markets all the certainty it needs, but what they can give markets the certainty is that they are willing to act when there are any signs of incipient inflationary pressures or pressures on the other side of a breakdown in financial markets. So that's the sort of reassurance that they can provide to markets, that they will act once there is a pressure building up in one direction or the other. But when all the indicators are very finely balanced, I think it's not reasonable to expect the central bank to provide more clarity than is possible based on the data.
The Fed has signaled 2 rate hikes this year, but we have only 6 months to go till December. So when can we expect these hikes? The next meeting is in July, after which it's in September. The September and the December meetings are followed by press conferences, and typically the Fed acts only when there's a press conference due. So does that mean the July hike is off?
It's hard to see a rate hike in July because whatever the outcome of the Brexit vote that's coming up in a week, there is going to be some residual turmoil in financial markets, and it's hard to imagine that there is going to be enough strong data in one direction coming out in the next month or so that will precipitate a move by the Fed. But having said that, you know, financial markets can start behaving in very strange ways. We might get a set of indicators both about real economic activity and about the labor market, and most importantly about inflationary and wage pressures that forces the Fed's hand. But I think it's highly unlikely, given all the uncertainty in the domestic and external environments, that the Fed is going to play its hand anytime soon. And as you say, that does create a bit of a complication if one thinks about the Fed seemingly committing to 2 rate hikes in the latter half of this year, because that squeezes the schedule a great deal. So we'll have to see even whether those 2 rate hikes do really come on board. As I mentioned, while the indications of the expectations, the famous dot plot of the Federal Reserve governors, which shows what they anticipate the Federal Reserve policy rate path to be, that is being completely discounted by markets, which seem to see a much more gradual pace of tightening and much more modest tightening. So it's becoming an interesting cat and mouse game with the markets, which I think is not great for the market certainty or for the Fed's credibility.
Yes, it is a bit of a cat and mouse game, but a Fed hike is always important for the rest of the world, since the Fed is a de facto central bank for the global economy. And for us in India, the timing is particularly critical this time around because we have close to $30 billion of foreign currency deposits maturing between September and December this year. Since these were mostly leveraged deposits created out of borrowing to tide over the taper tantrum of September 2013, chances are that a significant portion of that will not be renewed, and that proportion will increase even more if the Fed hikes rates. So will we see a repeat of September 2013, even if not to the same degree? Yes, our macro fundamentals are much better, but our forex markets are not deep. And in currency markets, it's very hard to say when a trickle becomes a flood, especially when the currency, the rupee, is overvalued, so that there is a built-in tendency to depreciate. In such a scenario, would it not be better to allow a gradual weakening of the rupee so that as and when the adjustment happens, it's not abrupt?
You're absolutely right, Mythili, that even though the US is not as large a player in the world economy in terms of GDP, US monetary policy still remains far more important to the rest of the world, including India, than any other central bank's monetary policy actions. Federal Reserve officials have indicated they are acutely aware of the implications of their policy changes on the rest of the world. Whether they internalize that in their own decision making is hard to tell, but at least they are cognizant of the spillover effects. But having said that, I think India is in a reasonably strong position to withstand the issues that you mentioned about in terms of the foreign currency exposures. But in addition, I think with the stock of foreign exchange reserves at the central bank, the RBI has built up, and the credibility I think the RBI has about its ability to step in and calm financial markets if necessary, I don't think there will be very substantial turmoil. In India's case, there are certain other emerging markets that are very vulnerable, have been vulnerable for a long time, countries like Brazil, Turkey, Argentina, Venezuela, these could all face significant pressures, even if an anticipated Fed hike were to be put into effect. So in India's case, certainly the uncertainty is not very helpful, and if I was sitting in the chair in Delhi or Bombay, I would certainly wish for more certainty from the Fed. But ultimately, I think India is going to be able to cope with the effects of a Fed rate hike or the uncertainty spawned by the lack of a rate hike much better than most other emerging markets. So certainly there is a possibility there could be a trigger effect that leads to capital outflows. But again, I think for India, the classical answer of keeping one's house in order to not be beset by external disturbances is still the best way to handle this.
Well, I'm afraid I'll have to interrupt you there, Ishwar, for a moment, because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm talking with Ishwar Prasad, Cornell Professor and Senior Fellow at Brookings Institution, Washington, on the implications of the two major uncertainties that have cast their pall over the global economy, the Fed vote as well as Brexit. The Fed has reduced the 2016 GDP forecast from 2.2% to 2%, but after saying that economic activity has picked up, does it mean the Fed has doubts about the US recovery?
I think we all have doubts about the US recovery because the economy does seem to have gotten back on track, but growth has been very uneven. And there are two factors in particular that create a lot of concerns about the durability of this growth. One is that investment growth in the US continues to remain very weak. A lot of the strength in GDP growth that we've seen has been on the backs of US households, where private consumption has held up quite well. If you don't have sufficient investment growth, that creates the lack of new jobs. It creates a situation where you're not generating enough wage growth, and that is a real concern. The second related issue is that productivity growth in the US has been remarkably weak during this recovery. Now, this is not specific to the US. Both the investment growth and the productivity growth weaknesses seem to be a phenomenon that is sweeping across industrial and advanced and emerging market economies.
Ishwar, yes, one uncertainty, the Fed hike, is now out of the way. But we have another big one, the Brexit looming ahead. The Fed acknowledged it again, but again in its vague fashion, saying that the June 23rd referendum would have consequences for economic and financial conditions in global financial markets. But I can't think of a more bland statement. We don't require a Janet Yellen to tell us it will have consequences. Of course it will, but what we have liked to hear instead is what kind of consequences. Some clearer statement from how the Fed reads the consequences of a lead vote. Will these be short-term or will they be more enduring? How will the world be able to deal with it, if at all?
It's very hard to do, Mythili, because the reality is that we don't know how financial markets are going to react. Again, remember, until about 2 or 3 weeks ago, it looked like the Remain camp was very much in favor, but the most recent polls that have come out suggest that there is a greater than even chance that Britain might vote to exit from the EU. And again, the offshoot is very unpredictable because markets do tend to price in risk in advance of an event. So if in the coming days markets see the possibility as being very high, we will start seeing some action in advance. Now, how much of a disruption this will cause to financial markets is again anybody's guess. But I think again what the Fed wanted to do with this statement was to reassure financial markets that if there is going to be a significant disruption, that they are willing to step in. And frankly, on this issue, I think the major central banks, the Fed, of course, but also the Bank of England, the ECB, and the Bank of Japan have shown their willingness in the aftermath of the financial crisis to intervene very heavily using both conventional and unconventional approaches to deal with any financial market disruptions. And certainly the Fed at this stage doesn't want to come out with any statement that might seem to be trying to influence the debate in Britain. It has enough complications trying to remain politically neutral in the US that I think they don't want to get involved in the British debates. So I think they just want to reassure markets that if something bad happens, we will be there.
So how do you see Brexit, Ishwar? At the end of the day, exiting the EU will hurt the UK far more than the rest of the world. Britain is not a member of the common currency, the euro, nor is the British pound remotely as important as the dollar or the euro when you talk of international reserve currencies. Yes, London is a major financial centre and many of its advantages will disappear if UK opts out. But once again, it is the UK that will lose. So are these fears exaggerated?
It's unclear. Again, we don't know how large the effects might be. And remember, there are additional spill-on effects because if this referendum does lead to an exit vote, Scotland has indicated that it might reinitiate a referendum to break away from Great Britain. So there could be very large spillover effects on Europe. And there is this important political overlay right now because you have a lot of political uncertainty in Europe as a whole with the right, the Conservatives gaining ascendancy across Europe, especially given the sentiments being unleashed by the refugee crisis, predictable effects on the politics as well as the economics of the European Union more broadly. And again, it's unpredictable what these effects could be, but certainly a lot of the forces that led towards integration of Europe could start creating pressures for more fragmentation, and that would not be good for Europe as a whole or indeed for the world economy.
Even if the Leave campaign succeeds, Britain has 2 years to negotiate an agreement with Brussels. So are the fears really because in the event of the Leave lobby succeeding, it could mean the beginning of the end of closer integration in the EU and eventually put the continuance of the euro at risk?
My reading is that that is exactly right. You're right that nothing changes overnight, even if there is an exit vote by majority in the referendum. But it does create concerns about whether the whole European integration project, including the Eurozone itself, could be at jeopardy. And as I mentioned earlier, the political overlay is really important here. In recent elections in many countries across Europe, many of the core countries, we've seen far-right parties gain ascendancy, and these political parties do have a somewhat isolationist message. So it could bring the whole European integration project into question and set off dynamics that make it very hard not only to promote more integration, but in fact that could set off disintegration in the future, given that there are very, very substantial centrifugal forces both on the economic and political side that are already putting a lot of pressure in Europe. So this could just act as a trigger to make those forces even more powerful. And that, I think, is a real concern for Europe at large.
So in your assessment, fears about Brexit are not unwarranted, and it's not that the Fed is looking for excuses to delay action when it acknowledged Brexit as a risk. Because if you remember, this is a complete sea change from the last G20 meet when the British Prime Minister David Cameron had a tough time convincing the G20 to even acknowledge it as a risk. So what has changed?
As of today, the polling numbers certainly suggest it is a real risk, and what one hears about financial markets and major financial institutions preparing for it certainly leaves one a lot more concerned. I was in London just a few weeks ago, and the sense at the time was that it would be a close vote, but that the Remain campaign would win. That certainly shifted, but even if the vote is a positive one, it's clearly going to be a close, or at least indications are it's going to be a close one, and that already sends a very powerful signal that a lot of Britain's citizens are not happy with the current state of Britain's relationship with the European Union. So certainly an exit vote could set off a large series of unintended consequences, but in any case, this is going to require a serious rethink of the relationship between Britain and the EU and among all the constituent parties of the EU.
My last question, Ishwar, is should we in India worry about Brexit, or is it that as far as India is concerned, it's always a Fed that matters more, never mind our colonial past?
The direct economic effects on India are likely to be quite limited. It's possible that if there is a vote by Britain to leave the European Union, that could lead to concerns and panic among investors who then rush to the traditional safe havens such as the US, Switzerland, Japan, and there is a short-term portfolio rebalancing effect that leads to money coming out of a range of other countries, including India. But frankly, I think the prospects of that are relatively modest. Again, among the emerging market countries, India still looks relatively solid, and given the very low interest rate environment around the world, there isn't a strong reason to pull money out of India. So even if there is a short-term panic-driven portfolio rebalancing effect, I think the direct effects in India are likely to be limited. If Brexit does lead to tensions within the European Union, that would certainly have an effect on an important export market, not just for India, but for many other countries as well. And that would certainly add to global uncertainty, which might have a knock-on effect on investor and consumer confidence. But I think these are all second-order effects for India, and the first-order effects, in my view, are not likely to be major ones.
Well, I'm afraid that's all the time we have in this edition of Macros with Mythili. The message from Ishwar, a very reassuring one for us in India, is that we are relatively better placed compared to many of our emerging market peers. Is that good enough? We'll have to wait and see. Fingers crossed. Thank you, Ishwar, for joining us.
My pleasure, Mythili. Thank you for having me on.
Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.